What's going on, guys? This is Passive Wealth Strategies for Busy Professionals. Thank you for tuning in. Today, our guest is Martin Saenz from Bequest Funds. Martin is a successful note investor. He's going to tell us all about his journey moving from getting fired from the corporate world after getting his MBA to starting his own company, selling it off, and now being a successful note investor. And today, what you're going to learn is how note investing works, how note investors survive/thrive really during a recession, how note funds make their money, kind of different structures of note funds, the types of notes that they invest in, and how Martin and his partners, his employees, focus on the borrower and the borrower's experience to make sure that their note payments are still coming in. Martin and his investors are still getting paid, even when times get tough. I think note investing is a great opportunity that a lot of folks out there just don't know about, and presents a really awesome opportunity for potential consistent cash flows, as long as you're investing in the right fund, right note, and all that. There's always caveats, but great potentials for cash flows, and really good potential opportunity for passive investors. So if you want to learn more about note funds, continue investing. Excuse me. If you want to learn more about note funds, continue listening to this episode. For those of you who are new to the show, I'm your host, Taylor Lote. I'm a real estate investor, real estate syndicator. I buy real estate with passive investors and split the return. Love learning new things. Love talking about note investing because, again, I think it's a great opportunity that people just don't know about. If you don't know about note investing, this is a great way to get started. And if you do know about note investing, you just might learn something new today from Martin Saenz. Without any further ado, here we go with the episode. Martin, thank you for joining us today.
Thank you for having me.
I'm excited to talk with you. You have such a cool story and a lot of things to teach us both about either entrepreneurship or real estate investing. But before we dive into that, can you tell our listeners a bit about yourself and what has, led you to where you are today?
Sure. In 2003, I was fired from a corporate job after receiving my MBA, and really kind of like my world came crashing down. Everything that I knew up until that point, getting an MBA, getting a nice secure corporate job, it kind of got turned on its head. So my wife and we really realized that we needed to take more control over our future, and so we started a small business. And what we learned with small business ownership was that it can be very taxing. 100-hour work weeks, and oftentimes you're struggling to make payroll, and other kinds of stresses that come along with small business. So we felt like we had obtained some level of freedom, but also we had some level of bondage that was placed upon us as well. Whereas everyone was getting paid but us, for a time, for the at least the initial few years. So we turned to real estate investing in '09, and we bought the building that we operated our company out of, and we bought the neighboring building, and we started buying commercial and residential properties. And the objective was to obtain financial freedom through landlording. And what we found is that it was great. We were making a significant annuity play because these properties were getting paid down every month that the tenants were making payments. However, we found that the cash flow was not matching our financial aspirations, and it wasn't, we weren't moving fast enough in that regard. So we sold our company, which was a federal contracting company, in 2013. And from there, I became a full-time note investor right out of the gate. So not finding financial freedom through small business ownership or landlording, which I own those properties still, by the way. We still manage those properties. However, we never found it there. So I ventured off into note investing to obtain freedom of time. That was kind of a change in the paradigm shift in terms of how I was kind of looking at things. And so that was my newest objective, was to really work on obtaining time in my life.
Nice. And then kind of fast forward to where you are today and how you've progressed through the note business. Uh, Tell us quick about the fund, if you would, just size and what you buy.
Sure. So the fund is Bequest Funds is an income fund that pays accredited investors a preferred rate of 8%, and it pays on a monthly basis. So it's really a vehicle by which someone can place money into the fund and receive a monthly dividend payment. So, in other words, it's like creating an additional stream of cash flow for oneself. And we launched the fund as an evergreen fund, and with the intention of it being a legacy wealth play for myself and my partner, as well as all the investors that invest in the fund. Something that you can place money into and have it grow and be passed down through generations over time.
So, forgive me for not knowing the term. What does evergreen mean in this context?
So a lot of funds come with an expiration time period, and 4 or 5 years. So what a lot of the fund managers are looking for is they're looking to max out the fund. Bequest is a $50 million fund. And so, what some funds do is they will go raise capital, build a portfolio, and then liquidate that portfolio in say a 4 year time period, by which they pay back all the investors their initial capital, and they receive a windfall for themselves as fund managers after liquidation occurs. We weren't looking to do that with Bequest Funds. We wanted something that would be a legacy play, throughout the decades, as many of these mortgages that rest in the fund are 20 to 30 year mortgage streams.
Okay, so fairly long term. And so can you tell us a bit about how a note fund like makes that 8%? And when you say 8% or whatever percentage return you happen to be paying to your investors in any given fund, like how is that generated through the note investments?
Sure. So I think it's good to start at how my origin started within the note investing space.
Sure.
So in 2013, I started out as a non-performing note buyer. So what that means is you have just to give you kind of some terminology, you have a promissory note, right? When you go get a mortgage, you sign a promissory note saying that you, the borrower, are going to pay back this amount of money to the lending institution over a certain over a certain period of time at a certain interest rate and other terms involved. And you tie that promise to a property through a security instrument called a mortgage or deed of trust. So you have really two instruments at play. Now, when borrowers become in default and they stop paying their mortgages for some reason, because they've had some life occurrence, then those financial institutions will pool those mortgages and create tranches, and they will sell them off into the secondary market space at discounts. So my company buys those tranches in the millions, and we're considered a very large buyer of those mortgages in the secondary market space. So we work with borrowers to create payment plans that the borrowers can afford now that they're back on their feet, and through that we create 20, 30 year streams of income for our company and our investors. Now, Bequest Funds is a separate arm in that it is a place where we place seasoned mortgages that have, hit other metrics in terms of investment to value and other criteria, and we place those into the income fund as a legacy play for wealth building for myself, my partner, as well as all the investors that invest in Bequest. So we buy those into our fund at a 12 to 14% yield, and we pay our investors an 8% yield, and the spread is what's there to allow us to operate the fund.
Gotcha. Okay. So I suppose probably one of the biggest, I don't know, objections or questions you get about it is like, so if there's this 14 to 15% to be made, why don't the banks do this on their own? I mean, they're probably starved for margin. Why do they sell these things off, to investors like yourself rather than restructure the notes on their own?
Yeah, so banks are not in the real estate business, and they are not really that sophisticated when it comes to working loan modifications. Plus, a lot of those loans, when they're originated with Fannie and Freddie underwriting guidelines, and they have certain restrictions being government sponsored loans. So they don't have the flexibility that someone like myself would have. So they cannot be creative in terms of payment plans. They take more of a rigid approach. So for them, it's better for them just to bundle that opportunity and sell it off. In some cases, and this is really above my pay grade because I'm not on that side of the fence as much, but in some cases, banks will charge off this debt. So then they're going to write it off their books, and yet they still bundle it and sell it for a profit. So there's all this kinds of accounting that's behind it that's really, outside my range of expertise. All that I know is that I am embedded in this secondary market space, and I receive these opportunities to buy this defaulted paper at a discount.
Okay. Now we find ourselves, depending on who you ask, we may or may not currently be in a recession, but unemployment is way up, and I consider that enough of a sign of a recession myself. Now, how do these, note funds and notes in general perform during a recession? I mean, some folks can't make their mortgage payment. There's also quite a bit of talk about forbearance out there that is maybe, I think, running out soon, at least as we speak. Does that affect you? I mean, let's really learn about how this recession impacts note investors.
Sure. Much of the forbearance programs run through the CARES Act, and those are for government-backed mortgages, and it's not applicable for the types of mortgages that we own. We're more in a private space with the mortgages we own. However, we try to run in accordance to what the CARES Act dictates, as just a matter of being kind of being going along the flow of the marketplace, if you will. And when we've had occurrences like pandemics or what have you, we've been very concerned and gotten conservative in terms of our collectability percentages that we're expecting. Normally in our industry and with our fund, we're looking at a 90% collected percentage. So in other words, if you have 10 loans, you're looking at 9 out of the 10 to be paying at any given time. So you can absorb a 10% default rate. So we anticipated at the lowest points in the market to be running at about a 80% collected, even 75%. And so we kind of prepared for that. However, we've been running this year that we're in now at a 93% collected percentage. So we've been above what the industry is normally, considers tolerable. So we've been very fortunate. However, that comes with a great deal of focus on one's portfolio, whereby we emphasize with all our asset managers that we emphasize relationship building with our borrowers. That's instrumental. That's kind of ingrained in our culture. So we're not there just there as like a call center that a borrower calls into. We have engagement with our borrowers, and we have it where they feel comfortable to call us if some occurrences come up, and we work with them. So there's a trust level that's involved with those relationships. So at the end of the day, if they lose their job and they have to make decisions about who to pay and who not to pay, we want the relationships to show at that point, and whereby they're like, well, we want to really pay this person, and it's their mortgage, by the way, where they live. So there's also that factor involved.
Yeah, they want to keep that. Now, one of the big questions that comes up when we're, say, talking about a single asset syndication, right, is we might have a 5 to 7 year business plan, and the way things are structured, if somebody passively invests, there are options to get out, but really it's best if you plan to be in the investment for the full 5 to 7 years. With your fund, you're talking about creating legacy income for 20 to 30 years, which is fantastic. But if before that time somebody for whatever reason needs to exit the fund, are there options, or what does that look like if somebody needs to get out?
Sure, and that's a great question. Really, what my partner Shawn and myself, what we had put out as the guidelines for the fund is that we we buy loans into the portfolio, and when the borrowers make those monthly payments, we in turn use that capital to pay our investors on a monthly basis. So we receive payments in monthly, and we pay our investors monthly. That's something that's very important to us because a lot of times funds or other types of businesses, they're receiving that revenue on a monthly basis, but then they're holding back on paying investors, unless they're holding back and paying investors on a quarterly basis or semi-annual. So we receive the money and we pay the investors. Now, why I mention that is because we don't have any leverage in the fund. So we don't have any institutional debt. So our investors are first in line to receive payment. That's very important because we go out to the marketplace and buy new product, buy new assets when we receive capital investors into the fund. So we're never stretched that way where we have to go and force someone's hand to stay in the fund. We have a 1 year lock-in period, and that's just because it takes us some time to source opportunities and place them with servicing, et cetera, et cetera. So there's some upfront cost in that. And so all we ask is for a year's time period, and then someone can bounce out of the fund if they need to go elsewhere. And what we'll do at that point is we will either backstop it. My partner and I will backstop that, and we'll put up the money so the investor can go. Because I'm the largest investor in the fund as well, just so you know. So I can go put additional capital, and if I need to, someone needs to go. We can bring in new investor capital, and then I can pay back that exiting investor, or we can liquidate some assets. The beauty about paper is that it's highly liquid. It can be moved very quickly.
Okay, so say with all these investments, one of the questions that also comes up sometimes with passive investors is the kind of documentation that they can expect for the tax man. Are investors receiving a K1 or like a 1099, or what does that typically look like? And before we preface this, no content on this show should ever be considered to be any kind of tax advice, period, ever. This episode and all other episodes included. So just as an FYI, this is a general question. Talk to a CPA. But Martin, please take it away.
I love the disclaimer. Investors receive a K1 at the end of the year. So these are interest payments that are made to the investor. So they will again, they'll need to talk to their CPA, but from our understanding, it will get taxed as ordinary income.
Okay. Good to know. So I suppose that incentivizes the use of something like self-directed IRA or 401k, a solo 401k or something like that, QRP, that has some tax advantage to it, but compared to ordinary income type of thing.
Sure, absolutely. We have some individuals, they'll use their Roth or traditional IRAs, solo 401ks. We also have some investors that are in riskier type opportunities, so they offset that risk by placing capital in with Bequest as a way to balance their portfolio.
How about minimums? What a minimum investment?
Yes, minimum is 25,000.
Okay, it's pretty reasonable. That's a reasonable minimum. That's pretty common.
Yes.
Restriction, is there a restriction to like accredited investors and that type of thing?
Yes, it's registered as a 506c income fund with the SEC. So what that means is one's going to have to qualify as an accredited investor to invest in the fund.
Okay. Yeah, I think these I think note funds are a great opportunity for potential for some passive income that folks just don't know about. They might be looking in like the REIT space or things like that, where there's a lot of volatility in the pricing. There is more liquidity because you can sell a REIT, a publicly traded REIT at any time in 10 seconds. But what I've observed is they have a high dividend, but the price tends to get really whacked by things like the coronavirus or the Great Recession, a Great Recession in which many REITs never recovered that same price. So it took 5 to 7 years of just dividend payments to make up for the hit in value. So I certainly see the appeal of a note fund investment.
There's a few distinctions that I think someone needs to look at when considering a fund, and this is just in general. Not all note funds are created equal. Some are set up as a non-performing note fund, and that's fine. It's going to pay more than 8%. But like anything else, there's always a higher risk associated when a fund is buying non-performing assets into the fund and getting those notes to perform while they're in the fund. So an investor may hit a higher return, which it could be something that someone's looking for. Other funds, like ours in this case, is an income fund. So all the notes that are in the fund are performing. So and they all hold we look for a 65% investment to value. And right now the fund's collectively at about a 63.5% investment to value. So that is if the fair market value is is 100,000 for the portfolio, then we're at our purchase of that mortgage note is at no greater than 63,000.
So in that investment to value equation, you have basically two numbers: your investment, which how much you're investing, and then your value. And how do you know that? Do you get a broker's opinion, a value on each deal, or is it the original notes valuation, or how is that determined? Particularly on a scale that you're doing, where you're doing so many notes that it's a substantial undertaking.
Sure. So we hit a lot of data points when we're looking at fair market value. We're running through resources like Data Tree, Realty Track, Zillow, Trulia, all those guys, as well as we'll pull automated value method reports, and in some cases BPO, depending on the value of the mortgage that we're purchasing. So we'll triangulate all the data points that we're hitting to try to get some sense of the value of the asset, value of the property. And in terms of what we pay as the investment, then that's based on what our cash on cash expectations are for that opportunity.
Okay, gotcha. Cool. Yeah, I think note funds are really great, and I appreciate you, building out that world for us. Right now, we're going to take a quick break for our sponsor. All right, Martin, I've got 3 questions I ask every guest on the show. Are you ready?
Yes, I am.
All right. First one, what is the best investment you ever made other than in your education?
It would be, actually, it's kind of one and the same. It would be when I first started note investing, I put out 240,000 of my own money to buy 10 first mortgage non-performing notes,
Wow.
and I got hammered. I got I beyond belief, and they were junk properties in Ohio. I overpaid for them. There was crime scene tape on one of the houses, and I learned so much about what not to do, and I'd say that's probably the best and worst investment. Maybe that answers both questions.
So you said you got hammered. Did you like lose money overall? Did you break even? Like what happened?
I'd be lying to you if I said I break even. That would be like that. I'd be happy there. I probably lost about 80,000.
Interesting. So was it a matter of like obviously paying too much, but not investigating the properties and seeing, or not knowing what you don't know? I mean, I guess those are all the things, but I guess what would you do differently? Look at the properties first.
That's a very astute question. I have to tell you, because therein lies everything that I'm about right now. The problem was I bought a note based on the value of, or perceived value of the property, when I should be buying notes based on the cash flow potential of the
Mm,
note. And so that's what I learned first and foremost, and that's carried with me, throughout the rest of my time as a full-time investor. And that is, focus on the borrower and their ability to pay, and as well as the property, because that's going to be your collateral for, in case of something bad happening with, foreclosure or some other legal ramification.
interesting. Wow. Well, we had the best investment. We might have had the worst investment too. I'm going to ask the question anyway. What is the worst investment you ever made?
I would say, in 2004, after I got fired from my corporate job, I my wife and I started a sign business, under a franchise name, and it was the worst investment because we paid everyone but ourselves. Like,
Oh no.
everybody got paid but us, and we worked our tail off. So we realized that, that was not the way to go. If you're going to work your tail off, you have to be reaping the rewards of it.
Nice. That's very true. My favorite question here at the end of the show is, what is the most important lesson that you've learned in business and investing?
That's an easy one. Buy assets that you can control and that cash flow. If it doesn't meet those two parameters, then don't buy it. It's not worth it.
Nice. I love it. Well, Martin, thank you for joining us today, teaching us about note funds, note fund investing, how it all works, how these things behave in a recession, and some moves, some good and bad moves that you made, I suppose, along prior to getting into note investing, or as you got into note investing. If folks want to learn more about your fund, learn more about you, where can they get in touch?
They can go to bqfunds.com to learn more about the fund. And also, too, I've written 4 books on note investing, and they can go to noteinvestingmadeeasier.com to learn more about note investing in general.
Awesome. Awesome. There are always, anytime notes come up, I feel like there are a lot of questions about where can I learn more about this. So books are certainly a welcome resource. Well, Martin, thanks once again for joining us today. To everybody out there, thank you for tuning in. If you're enjoying the show, please leave us a rating and review on Apple Podcasts. It's very much appreciated, and it helps other people learn about the show. If you know anyone who could use a little bit more passive wealth in their lives, please share the show with them and bring them into the tribe. Thanks for tuning in once again. I hope you have a great rest of your day and a great week, and we'll talk to you on the next one. Bye-bye.